Good evening and welcome to The Money Show, the only show of its kind which brings the market's top financial experts to answer all of your financial queries. I'm Avni Raja, with me Avan. Hi Avan, we'll get to the headlines first.
Absolutely, Avni. We've got lots lined up on the show, so let's get cracking. Well, first up, sources suggest that the stock exchanges and brokers recently met with the Finance Ministry officials with their wish list. The abolition of capital gains tax, in addition to rationalization of securities transaction tax and commodities transaction tax, have been some of the key demands. That's an ET Now exclusive.
Commerce Minister talks exclusively to ET Now, welcomes the prospect of Apple expanding its local manufacturing in India, says all FDI is welcome if it helps in job creation. He also vows to fix export woes arising post-GST rollout.
And to the markets, there was a sharp rebound from the low point of the day. We ended flat, though it was near a 3-week high. It was media and realty which led the recovery. The broader end of the market outperformed. Metals and FMCG lost out in trade today. Well, let's get cracking then and bring on board our guest. Mayur Milak is research analyst at Indianivesh. He joins in to talk about perhaps a rise in the overall in passenger service fee, which is likely, as well as Gajendra Kothari. He's MD and CEO, Etica Wealth Management, who will be guiding us with all your queries over the next half hour. I'm going to come to you then Mayur. And, you know, it seems like passengers need to brace themselves to shell out more money for air travel because the government is looking to raise the passenger service fee by almost 38% to meet the cost of security at the Indian airports. Give us a sense as to what exactly, this would mean for regular flyers and whether or not we are going to see a hike, and will it be fairly substantial or not?
Yeah, so I think while we're looking at this hike, I don't really see that as a very meaningful hike. So yes, while the cost will tend to go up to some extent, but I don't really think that is a kind of damage that can really cause any demand to really flow out. So I still think crude being down, that should be conveniently taken in.
Right. Mayur, thanks for joining us today. I wanted to get, your sense while you're saying that this particular move will not have too much of an impact as far as prices may be concerned. But even there's several small things that could... all right, I think we seem to be... all right, there's... Mayur, can you hear me?
Yes. Okay.
There's several small things that keep coming up, which, add up as far as the customer is concerned in terms of the cost of the ticket they pay.
Yes, so I think if you really see over the last, 2 years, we've seen in terms of competition, there has been a lot of add-on in terms of costs. But at the same time, we've seen, demand really coming in very strongly at 15% plus for almost 24 months now. And the expectation going forward is similar. And now with the Udan scheme coming in and more connectivity coming to the regional airports, while yes, these costs do go up, but we've seen a significant drop in terms of crude costs, which I think should take care of the overall. So we've not really seen any major increase in yields as far as the aviation companies go.
Mayur, since you track this space quite closely, give us a sense as to after how long we are looking at this kind of potential move in terms of the overall hike in the passenger service fee, and whether or not, this kind of a trend is likely to happen soon. Is it infrequent or does it tend to happen fairly often?
So I wouldn't say it's often, but if you see, all your 4 major metros, especially Mumbai and Delhi, they're as good as running 90% plus capacity utilization. In fact, Mumbai is almost 99%. So anything on these lines will really not damage any demand as such, because you're really looking at a capacity shortage. Having said that, yes, these hikes are always, they're not really wanted in a big way. So anything of this may be initial for a very minor moment or minor disruption, but that's about it. I still believe demand is way too strong to really, be affected by these hikes.
Okay, so in conclusion, Mayur, just to understand that you're saying that this is only going to be a slight increase and it won't really affect the pockets of customers and passengers?
Yes, we want to believe it that way.
Appreciate that. Thanks very much for bringing us clarity. That was a bit of a news bit that we wanted to address and just talk about how it would impact regular flyers as well as those looking to travel by air. Well, let's Move right on to another news bit, and the government could be looking at the formation of a new policy. This is for the gems and the jewellery sector. Let's hear it from Mr. Pandya as Rituparna Nath caught up with her. He's the head of the Gems and Jewellery Association on some of the key recommendations that have been made to the Commerce and Finance Ministry.
We have already given some recommendation. There are recommendations for various items, for instance, diamonds, gold, silver, because, we want to transform India by 2022 to be the largest exporter of jewelry in the world. We want to be the jeweler to the whole world. So for that, we need to have several this thing. The most important thing is the duty on gold, which has been taken up from 1% to 10%, has to come back to the realistic level of 4 to 5%. Because any duty beyond this, triggers the smuggling. We want one gold board to be probably created under the aegis of Commerce Ministry, which should have members from RBI, from Finance Ministry, and they should come out like exim policy, one policy for which should last for 5 years.
Right. So you're talking to the government about that as well?
Duty. Yeah, import duty on the gold. Another thing we want is this, that in this industry, especially in diamond industry, you see word over there is presumptive taxation. That means on turnover they have a taxation. So you don't have to go through the rigors of very specified valuations that is required in this industry. So all other countries have the similar provisions. So we have also made that recommendation for the budget.
All right, let's in fact go across to Gajendra Kothari, who's with us at this point. Gajendra, as far as this gold policy is concerned, can you help us understand how could it possibly impact the prices as far as gold is concerned?
Yes, of course, it will be great news if the gold duty, the import duty is halved as was just heard, from 10% to 5%, because then the prices would come down, and it will be great news for the investors to buy, because presently the government is trying very hard to increase the investments in gold through the sovereign gold bonds. But we have not seen much of offtake in the last 1 year, because maybe gold has not been doing as well, over the last few years. And equity markets doing pretty good, so most of the attention has been money has been going through mutual funds in that space. Even when we track the gold ETF funds, there's been rather outselling, rather than inflows. So with gold duty coming down, I think there'll be a lot of renewed interest coming back to gold, and that would be good news for the investors who want to invest in gold.
Gajendra, I wanted to just understand as well what some of the other, what is the wish list, because Suresh Prabhu has said that he will look into other schemes as well in order to help boost the overall exports from the sector. How do you see, what are the current problems or, spots of bother when it comes to prices of gold and import duty, etc., and what is the wish list from the industry?
Yeah, one, as was rightly pointed out, when the gold duty, the rate is 10%, then most of the gold, there's a big problem with smuggling. So we see gold coming through physical form. We have seen, from Dubai and many other countries. But the moment you half the duty rate, then investors tend to buy gold in the electronic form, which is what Government of India wants to do. Financialization of all physical assets. That will be a great step towards inclusion of all these things into the economy. So I think it will increase the monetization of gold in a big way. So that would be great from the point of view of leakage, because there will be hardly any leakage thereafter. So I think it will be a good step if the duty comes down and more people invest gold through the sovereign gold bonds.
Right. Right, Gajendra, before we step away from the gold conversation, are you really seeing a trend that's of people, investors moving away from gold to other assets like financial assets largely? Is that trend happening?
Yes.
Yeah, because traditionally, one in India regarded gold as a safe haven.
Right. No, it has been. As a financial advisor, when we talk to investors, because gold hasn't been doing much in the last 5 years, people have lost sheen, that kind of, in gold. And because equity markets and mutual funds doing pretty stable and good. So over the last 4 or 5 years, people have kind of not added any new money into gold, but they have not sold their gold investments either actually. They've just hold on to it.
Okay. Okay, thanks very much for giving us that perspective on what it would really mean, this policy, what measures could perhaps be announced and how it would affect the overall prices. So clearly, gold has over the past few years lost its sheen. Investors which traditionally, resorted to this sector as safe haven is now seeing that demand sort of waning off is what Gajendra is saying. Well, let's move right on and talk a little bit more about the overall sphere of personal finance. And a topic of discussion, Gajendra, that you brought up was investing in equity funds via an SIP versus a lump sum. I'm sure this is also quite a debated topic for a lot of investors. So help clear the air over here.
Yeah, so this is quite funny to see, in the sense most of the investors when we talk to these days, they say, I want to do an SIP. I don't want to invest lump sum, because they somehow have a feeling that investing through SIP is a sure shot way of making money into mutual funds. Even if they have lump sum money right now into the account, they would like to spread it over maybe 4 years, 5 years as a SIP. So, as advisors, we believe that if this money is anyway to be invested for longer term, and if you have conviction that the market would offer you decent returns going forward, maybe 12, 13, 14%, and if the markets are fairly valued, then, putting the same money through SIP does not make sense, because then you lose the power of compounding. Because your money still is sitting in the bank account earning you 4%, and you have to wait for as long for that money to be deployed. So,
but, sorry, if I can just interrupt you, Gajendra. In that case, would it not be recommended to opt for an STP where you put your money into say a debt fund or something and then transfer it on a systematic basis?
Absolutely, Avni, because that would be any day smarter strategy, because your money is now at least earning you 6 to 7% returns, better than the savings bank account returns. But having said that, what I've believed is that if your investment horizon is 10 years, 12 years long term, then whether you invest, and people tell that okay, Sensex will touch maybe 1 lakh after 10 years. So if Sensex is going to touch 1 lakh, whether you're investing at 33,400 or 32,800, does it really make difference? So you should let your money go right away and be there for longer term. Now the only problem is if the markets are little richly overvalued, or if you're a first time investor, and then if you just want to ride out that volatility, maybe for the first time investor, it's a good idea to go through that STP route.
Right.
Otherwise, it doesn't make sense.
Okay, that is investing in equity funds via the SIP route or a lump sum purchase. So talking about STPs and SIP, which is a far more conservative and a far better tool, especially for those who are first time investors. Well, we're taking on board all of your questions and queries. All of that is coming up in just a short bit. Stay tuned to The Money Show.
Welcome back. You're watching The Money Show, and we have with us Gajendra Kothari in the studio to answer all of your personal finance questions. Gajendra, let's get to our first question that's come in, which is from Raman from Chennai, who says, I'm currently retired and would like to understand how a retired individual can get monthly income by investing in mutual funds. Can you share other avenues to invest in for monthly income as far as retired people are concerned? So this is something actually we get asked quite a lot, because a lot of retired people wanting to know how they can continue the monthly income, especially, which is, I guess, perhaps the most important thing for them. What would your advice be for Raman?
Absolutely. So most people think that mutual funds are only SIPs. There's a great facility in mutual fund called SWPs, which is Systematic Withdrawal Plan, and that is precisely for the reason that you can have your monthly withdrawals coming into your bank account. Of course, you can do SWP from any kind of a mutual fund, be it a debt fund or an equity fund. Of course, the selection will also depends on your risk appetite and your return expectations. If you're right from 7% return per annum to a 15% return per annum, there are various products. Now, if you have been an investor who has always put your money into bank fixed deposit, but now because the bank rates are coming down and are wanting to look for a better option, then we can recommend you something called equity savings funds, where you have to take a little bit of aggressive position in equity, where your 20% or 30% money goes into equities, but 60-70% goes into debt, which can offer you anywhere from 8 to 10% tax-free return over a 3 to 5 year period. So the risk profile of this fund is a kind of a conservative, but tax profile is of an equity nature. And just to give an idea, Avni, somebody who invests 10 lakh rupees can expect to get anywhere from 7 to 9,000 rupees per month after a year tax-free coming to the bank account. And most mutual fund offer this kind of fund, equity savings funds. Maybe the investor can go into like Kotak Equity Savings Fund or an Edelweiss Equity Savings Fund, which have been doing pretty well. You also ask what are the other options. So there are two very popular options called Senior Citizen Savings Scheme. Somebody who is 60 and above and want to get a guaranteed returns. 8.3% return is what they can look for, but this is payable quarterly and not monthly. Okay, and this is taxable too. The other option is Post Office Monthly Income Scheme, which is not as attractive as Senior Citizen Savings Scheme. That offers you around 7.5% monthly income per, going forward. So,
and what about annuities and other products from insurance companies as well, which provide you monthly income?
Yeah, so most of them are not guaranteed returns that way. And the problem with annuities is that they are taxable also.
Right.
So that's where the challenge lies.
Okay, so a number of options: Senior Citizen Savings Scheme, looking at some of the other equity savings funds that you can look at. He recommended the Kotak Saving Edelweiss Equity Savings Advantage Fund. And clearly, it is important to know your overall risk appetite as well as your return wants. Hope we were able to help you out with that question. Let's move on then to Mr. Suresh K's question. This one has been sent in to us on Involve. He says, I'm 36 years old and my employer covers about 3 lakhs in health insurance. Do I need more cover and should I buy a separate critical illness cover? For a lot of people in this sort of an age group with health insurance of a sum of 3 lakhs, what is it that you would advise and how critical is the critical health cover?
Yes, so certainly most employees who are covered by employees' health insurance policies, they think, okay, I don't have to go for any other cover. But that's actually a misconception, because there are two things which can happen. Suppose if you are in between jobs, you've changed your company and you're now looking for another job, and what if something happens to you or your family members? Now that can have a big hole in your pocket at that point of time. So we strongly recommend that you should have a standby cover. Now that standby cover may be of a lesser amount. So suppose if your company is covering your 10 lakhs cover to you and your family, you may go for a 3 lakh rupees alternative cover, which is always a standby cover and where you are paying quite a minimal amount. So, if at all, you can always fall back to that policy. So that is something which I would recommend. And second is critical illness cover is very much essential for today's youngsters, because the kind of lifestyle we are living, we hardly have any time for exercise or any other thing. So critical illness cover will give you that lump sum amount the day you have any critical illnesses. One thing we should always realize: the moment somebody is diagnosed with a critical illness, it's not just about financial thing. The entire thing gets upset. And if the patient gets around 10, 20, 30 lakh rupees lump sum, that gives him great comfort to plan his cash flows for the next 6 months or 12 years. So I think it's a great thing for a young person. Even the premium is not very much. For a 10 lakh cover, Suresh, for your age, hardly you'll be paying around 7,000 rupees per annum. And this is all, of course, eligible under Section 80D tax benefit also.
Right. Gajendra, I'm going to go back to something else that you were talking about, the equity savings fund specifically. If we can just elaborate a little bit more, because it's a relatively new category compared to the traditional other funds that we have offered from companies. If you can elaborate a little bit on how this really works, what kind of an investor should typically invest in it, because the word equity in the name perhaps can confuse people, and perhaps their return expectations might be slightly different.
Yes, Avni. In fact, it's, in my opinion, this is a fantastic category of funds, for most investors to invest, because the beauty is that the risk profile of this is like a fixed income fund, but the tax benefit which you get is like an equity fund. So these are very conservative funds. Somebody earlier in mutual funds, there was a product category called MIPs, monthly income plans, which was of a very similar profile, but there hardly 15 to 20% of the money was going into equities. In this case, around 20 to 30% of your money goes into equities. The remaining money actually goes into debt and arbitrage opportunities, which anyway fetches you around 6%, and equities can give you around 10%. So net what we're looking is to have 8 to 10% kind of a return over a 3 to 5 year period. Now this is very relevant for conservative investors who have traditionally put their money into equities but are now not very comfortable because of the falling interest rates and taxation. So if they are willing to take little risk and take the first step towards investing into mutual funds from long-term point of view, can actually look forward to invest in these funds. One can expect around 8 to 10% returns over a 3 to 5 year period. This should be the holding period, and this gives you far more stability compared to other balanced funds or equity funds. So,
and as far as taxation is concerned, how will this be taxed?
So normally in debt funds, the short-term capital gain is levied before 3 years. This being considered as an equity fund, after 1 year that returns are tax-free, and even before also, if you are encashing out, all you have to pay is short-term capital gains of 15%, which is applicable for the equity funds.
Okay, there you have it. That's the lowdown coming in on the equity saving funds, talking about how it invests a third in equity, arbitrage and fixed income. About 8 to 10% is what you can expect over the next 3 to 5 years, and it should be a fairly low risk fund, so a fairly conservative risk appetite would be prudent. On that note, Gajendra, would like to take time out to thank you for being with us in our studios, helping us out with those viewer queries and these discussion pointers. For now, we wrap it up on the show, but do remember tomorrow is when we have our Money Show special, and that is going to be on debit and credit card fraud. We have a cyber expert, Ritesh Bhatia, joining in, as well as Harsh Rungta, who will be with us tomorrow on the show. Actually, not on the not really on the 24th of November. It's on the 28th of November. That's tomorrow.